Right, welcome to this lecture. Today we want to look at the value-added tax return. Right, last time we looked at pay-as-you-earn return. So today we want to look at the value-added tax return. You only do this return if you are registered for value-added tax. So it's not every company which does this return. This return is different from your pay-as-you-earn return. Because once you register as a company, you are supposed to automatically register for pay-as-you-earn. But for value-added tax, you have to meet certain requirements for you to be registered for value-added tax. Let's assume that you are already registered. Now, if you are registered, what it means monthly, by the 10th of each month, you are supposed to do a VAT return. So when you log into your Tarms, you come to tax return management. So you click on tax return management, then you click on pending tax returns. Because what the system does is, by the 1st of each month, they post the return on your portal, so that by the 10th, you must have submitted the return. So when you click there, pending returns, you are taken to this window, then you are shown the returns which are pending. Like for this company, there is a payee return which is pending. There is also a return for remittance of value-added tax. This is the one that we want to look at. So if you are to do the return, you just click on that. Then it will load up. It will load up the fields into which you are supposed to fit in figures. Now, for you to do a VAT return, basically VAT return is done when you have done your computations. Your output tax are matched against your input tax. The output tax is on your sales. When you're selling, you're charging customers VAT or value-added tax. When you buy, it could be your trading goods, or it could be capital goods, it could be services, you are charged value-added tax. So when you are doing this return, you are matching the input tax against the output tax against the input tax for you to get either a VAT payable or a VAT refund. Okay, let me share this with you so that you may appreciate. So this is your QuickBooks accounting system. So when you are doing your day-to-day, you are selling to customers by creating invoices, right? You could use any accounting system. So you could be selling to your customers, charging VAT. This is your output. This total VAT will be your output VAT. Then you are also buying trading goods from suppliers. So you are doing that by entering bills. You're buying services, you're buying goods. So at the end of the month, you have a report. You have a report like this one. Let's just check accounting the taxes, and let's check this report, right? So you have a report like this one. Let's just customize. We want to select so filter, then we'll filter by account. Then we will just look up the VAT liability account. Let's just look that up. It's just down here. Right. Let's look it up. It's VAT liability account. So we'll look up this account. So what this account does is, you are doing your sales, it will be recording the VAT coming from the sales. This company, most of their goods are 0 rated. So, but if you scroll down to the end of this account, they've done a number of transactions, and yeah, you could see these 2 sales were done and VAT was charged. So this is your ledger account, the value-added tax ledger account on your accounting system. So this credit column represents the VAT that you charged on the sales. The debit column represents the VAT you could have been charged for the purchase of goods or services that you did. So this account eventually could knock off the 2 and show a payable or a refund. In this case, this company is supposed to pay $16.80 because it only collected VAT. It was never charged VAT. So within accounting system, the computation is automatically done. If you were doing it with a manual system, it means you could have either to use Excel to do a computation. You're adding up your sales and your value-added tax. You're adding up your purchases of goods and services and the value-added tax that you were charged. Then you're knocking off the two. Then from there on, you can have either a VAT payable or a VAT refund. Okay, let me go back to the portal so that we see how we are supposed now to do this. So you'd find once you are in your portal, you have to select how you are declaring. Are you only doing it for USD? Because you could do a USD return on its own. You could also do a ZWG return on its own, or you could just do the submission at once. So when you click USD and ZWG, like what I did, you could find this side is for USD, USD value of supply. So I'm going to explain as we go. Then this side is for ZWG. So the first part is you are putting in your sales. That's what you are doing. You are putting in your sales. So let's say you had sales of $500. I'm just using this as an example. You input that. These are sales net of VAT. In other words, I'm saying these are sales which do not include your value-added tax. Right? That's what you are putting. So when you put that, the system will compute the VAT which is due, $77.50, which means the sales that you did, the gross sales that you did, that is including VAT, was $577.50. But when you come here, you're inputting the 500, excluding your VAT. The same goes with your ZWG. The 1,000, I'm just going to put 1,000 there, doesn't include VAT. So you are putting up that. So these are the sales that you did, the total sales that you did. You could take this from your accounting system, or you could take this from your manual books. It all depends on what you are using. Then in this second part now is you are putting those sales that you did which were zero rated. In other words, no VAT was charged. As you saw, that company had most of their sales without VAT. So what it means is you could put the sales there that you did but were not charged VAT. So you're just putting up that, right? So you could find the system doesn't calculate VAT because these are zero rated, right? Then you could come here and right, if there are any other suppliers like at 5%, at 2%, at that, you could come and put up that. But mostly those are the two that you have to put. Then if are there any deemed sales? So when we speak of deemed sales, these are like let's say you are providing company vehicles to staff and they take the vehicles home. They use the vehicles for work. They also use the vehicles for personal use. You have to compute the vehicle benefit and pay value-added tax on that. So you have to compute and bring up, those are deemed sales. So you could put up those deemed sales here. Those are considered deemed sales. Then exempt sales, those are like your sales that you did, which are not charged the VAT at all. Because in Zimbabwe, what we have is we have got goods which are charged the VAT at standard rate, which is your 15.5%. Then you've got goods and services which are charged VAT at 0%. Then you've got goods which are exempt, meaning to say no value-added tax is applicable. When you go to supermarkets, supermarkets, those who do groceries, that's where you find all the categories of exempt goods, meaning to say they're not charged the VAT. Zero-rated goods, meaning to say they're charged the VAT but at 0%. Then those which are charged VAT at 15.5%. So those will be the goods that you put up there, right? Then once you do that, you can do the calculation, but the system does the computation. As you can see there, it added up my USD totaling 3.5. Then this is the text on that. It added up my ZWG, bringing up this total. Then the VAT payable is that. So this first part has to do with your output tax. That is the VAT that you charged on the sales that you did. But you have to list all the sales that you did, those which are charged 15.5%, zero rate, exempt, or any other tax percentage that is applicable, right? Then once you are complete, you then go on and do your input. So your input now is the VAT that you were charged by other suppliers. You should have a fiscal tax invoice for that. You should have a fiscal tax invoice. What we're simply calling a fiscal tax invoice, let me share. Do I have one here? Let me share. Right, a fiscal tax invoice, let me share that. Should be something like this with, right, I'm going to share this. So it should be something like this with a QR code. This QR code, which when you scan, it's already linked to the Zimra fiscalization system. So when you scan it, you can find that invoice in the Zimra system. So if you are to claim any input VAT, you must have a fiscalized tax invoice. You're not just claiming from nowhere. So that's very much fundamental. Let me go back. So let's assume that you have got the fiscal tax invoices. So you put the purchases that you did before VAT. You're putting the figure before VAT. The same goes here. I'm just going to put some arbitrary figures just for demonstration purposes. So when you do that, it will do the computations. As you can see here, we purchased goods and services for $340. We charged that VAT, $45.62. The same goes here. We did these purchases for $670. We were charged this VAT, right? Then this second row is change of use of capital goods. That is, you probably bought a capital good, like, okay, let's say a computer. And when you bought it, you were charged VAT. You claimed the VAT. You claimed the VAT because you were charged it. But later on, you converted the laptop. Instead of it being used by the business, you took it home and probably gave it to your child, or you just decided to use it yourself, which means you converted it to own use. So if you have such a scenario, you have to put the figures there because you are supposed to return back the VAT that you once claimed, right? Then here, you are supposed to put bad debts recovered, right? You are only putting bad debts recovered if you claimed those bad debts in your income statement. Right. We haven't touched the income statement or the income tax return. We haven't done the income tax return. But when you are doing your income tax return, if you prove that certain debts are no longer recoverable, you can claim them as expenses. But now, on the VAT return, once you recover those bad debts, because a debt may seem to be unrecoverable, but later on somehow the client is able to pay. So once you recover those debts, you are supposed to put those figures here so that you pay back the VAT return. Debit notes issued, debit notes, the nature of a debit note to a customer is you raise an invoice of 10,000, right? But later on you find that you undercharged. You were supposed to charge 11,000. So instead of doing another invoice, you do a debit note, which is an additional charge on the previous invoice that you did. So you could just put in the debit notes there. Then if you received any credit notes, you could just put them there. Then okay, the motor vehicle. So the motor vehicle is here. The motor vehicle is here. If there are any fringe Any fringe benefits, you could put them there, right? So you could find so you could find once you do that, so basically these areas I was looking at are meant to adjust your output. They are meant to adjust your output VAT. So you see, change of goods for own use. So you're putting up that uh, uh, if there is anything there. So this is not input aside. This is in addition to the output that we put up there. So all these things, like your bad debts, if you recover them, if you issued debit notes, if you received credit notes, these are like income. Not necessarily income in the sense of financial accounting, but income in the sense of VAT computations. So you're putting up all those. They will add to your output tax, which means my output tax, as you can see there, is now adjusted with the 77. Now it's adjusted by these items to bring it to 123 for USD and 244 for Zim. The input tax is done down here. So here, that's where you are doing your input tax. You have what imported goods to make taxable supplies. If you have them imported, you could put the amounts there. If you are to put the amounts there, you must have bill of landing, like your customs clearance papers, which prove that you imported these goods for your business. Imported capital goods to make testable supplies. So again, these imports must have to do with your business. Again, you should have import papers to prove that. Then the domestic capital goods purchased to make taxable supplies. So meaning to say, again, if you bought capital goods, it could be motor vehicles, delivery vehicles for your business. You put the figures here. Again, you should have invoices which prove that you bought. And as I said, these invoices are supposed to be fiscal tax invoices. Then VAT on imported services. If you imported some services, you could have imported some accounting systems. It could be an enterprise resource planning software. You may have imported that, and you should have customs papers to prove that. Exempt purchases, imports, you could just put them there. Then you could then adjust change of use of goods. You could put them there. Change of use of capital goods, bad debts written off, could put them there. So once you put that, so let me just put. I want to put some figures there. Let me. Right. Let me put. Right, for this company, right, this company cannot, it's not registered, it's registered VAT exempt total, right. Probably let me just put a figure there. Let me just put a figure like 120, and probably, yes, let me just put that, right. So once I have that, I can, so what the system does now, it will compute, okay, another thing that I need to point out is this VAT withheld. So the VAT withheld, what happens is, so we've got the output, which is on sales, we've got the input, which is on purchases, but you could find if you're dealing with certain companies, let's give an example of Delta Zimbabwe. If you are supplying Delta Zimbabwe, you have invoiced them. They have been appointed a tax agent by the Zimbabwe Revenue Authority. What it means is when they pay your invoice, they withhold the VAT component of that particular invoice. They will withhold a third of that. So you can claim that. They will give you what is called a VAT tax certificate. which you can use as an invoice to claim that. So if ever you had such a scenario, you can put the amount there, the amount that was withheld. Then the system will do the computation, and it will reduce your VAT payable. Right. Then down here you can attach the input tax schedule for USD. The same goes for ZWG. Then once you are ready, you submit. So basically, this is how you do your VAT computation return, so to say. What is important is you must have your sales, right? Okay, you must have your sales. You must be registered for value-added tax for you to do this. So you do your sales, you put in your net sales there. The system will calculate the VAT. That is the USD. You put your net ZWG. The system will compute. You input all the necessary figures if they are there. If they are not, you are leaving those columns blank. The same goes with these adjustments. If you've got none, you are leaving them blank. You come here, you do the input. Now, when you're doing the input, you are claiming the input based on what you were charged. You must be registered for VAT. The system will do the computation. Then down here, if you supply the company which has been appointed a tax agent and they withheld a third of your VAT component when they were making payment to you, you can claim that down here. Once you do that, the system will do a computation, then you submit that. You can attach this input tax schedule. The same goes for the USD and for the ZWG. You must have calculated this. Then you attach them, then you submit. Once you submit, the tax return goes into the Zimra system. Zimra will validate that. They don't necessarily come to check end of month or end of year. They may just do some routine audits here and there. So basically, this is how you do your value-added tax return. You must be registered for value-added tax for you to be able to do this. Thank you for watching. See you in the next video.